Welcome to Course 4, Module 1, Chapter 3, The Business Case for Circularity. In this session, we look at circular economy not as a soft sustainability theme, but as a financial redesign challenge. The central question is simple. How can circular systems create growth, reduce cost, and manage risk better than linear systems? We will connect academic frameworks with practical corporate decisions, especially from the perspective of finance leaders. Throughout the chapter, notice that circularity requires upstream choices about product design, supply chains, ownership, and capital allocation. The strongest business cases do not simply recycle waste at the end. They redesign the system so materials, products, and customer relationships keep generating value for longer. Frame the chapter as a practical investment conversation from the start. This agenda shows the path of the chapter. We begin by reframing circularity as a financial imperative, then move into CFO-relevant frameworks for circular supply chains. After that, we examine how circularity can support growth, reduce the cost of goods sold, and strengthen customer value. The middle of the chapter focuses on return on investment, risk mitigation, and access to green capital, because these are the issues that determine whether projects move beyond pilots. We then discuss business model overhaul, including product as a service, second life products, and secondary material markets. Finally, we ground the theory in regional cases from the Netherlands, India, and Thailand, before closing with the main financial lessons. Use it as a roadmap so listeners can anticipate each financial theme. Circularity must pay for itself. This is the core premise. Circularity must create measurable financial value. It needs to reduce costs, protect against resource and supply risk, and open new revenue opportunities. If the economics are not visible, circular initiatives remain isolated sustainability projects instead of strategic business investments. Here we reframe sustainability as financial redesign. Traditional sustainability programs often start with compliance, reporting, or brand positioning. Circularity goes further because it changes the economics of the operating model. By decoupling growth from finite virgin resources, a company becomes less exposed to commodity volatility and supply disruption. By recovering and reusing materials, it can structurally reduce input costs and waste-related costs. By designing for second life, repair, and services, it can capture value after the first sale. The important point is that circularity changes the cost base, the risk profile, and the revenue logic at the same time. That is why it belongs in capital allocation discussions, not only in sustainability departments. Highlight that these benefits must be designed into core operations. This slide introduces three important streams of financial thinking. The resource-based view treats circular capabilities as strategic assets. Eco-design, resource recovery, reverse logistics, and industrial symbiosis are not side projects. They are capabilities that require investment and can create advantage. Green finance then provides instruments that match the nature of circular projects, including green loans, bonds, subsidies, and tax incentives. These tools are useful because circular infrastructure often has high upfront cost and long payback periods. Finally, business model innovation explains how the value is captured. Firms can reduce inputs, add service revenues, recover residual value, and lower risk. Together, these perspectives make circularity an investable proposition. This connection explains why finance, strategy, and operations must evaluate circularity together consistently today. Turning circular supply chains into investable business cases. This section translates circular supply chain ideas into CFO language. We will examine how different circular models affect revenue timing, margins, asset intensity, capital needs, and risk. The goal is to show how physical loops become investable business cases. Circular business models connect physical loops to financial value. Closing loops keeps materials in circulation through recycling or cascading. Slowing loops extends product life through repair, reuse, refurbishment, or remanufacturing. Intensifying loops increases utilization, often through sharing or service models. Narrowing loops reduces the amount of material or energy needed per unit of value. Dematerializing replaces physical ownership with service, access, or digital delivery when possible. Each pattern has a different impact on margins, cash flow, and asset intensity. That is why finance teams should not evaluate circularity as one generic category. The same product redesign may affect cost savings, residual value, service revenue, or asset productivity in very different ways. Clarify that each loop creates a distinct financial mechanism. This table makes the investment logic more concrete. Repair and reuse can extend revenue from existing assets, but they require service capacity, inspection, and triage. Refurbishment and remanufacturing can lower production cost per delivered service, yet they need reverse logistics and certified restoration capabilities. Recycling and cascading recover residual material value, but sorting, processing, and quality assurance become essential. Product as a service can produce recurring cash flows and higher lifetime margins, but it also means the firm keeps ownership of assets and faces a longer cash conversion cycle. For a CFO, each pattern is a different capital allocation decision. The question is not whether circularity is good, but which model creates the best risk-adjusted return. Invite comparison across patterns before choosing a pathway. The resource-based finance perspective explains why circular ambition depends on capital quality. Firms may want to invest in eco-design, resource recovery, reverse logistics, or industrial symbiosis software, but the scale they achieve depends on the financing available. Internal equity, green loans, subsidies, and tax incentives differ in cost, collateral requirements, repayment terms, and risk sharing. Those differences determine whether a company can move from small pilots to systemic redesign. The key message is that circular capabilities behave like strategic assets. They require funding before they generate returns. If capital is too expensive or too uncertain, projects remain narrow. If capital is well matched to long payback periods, circular transformation becomes more feasible. Emphasize that cheap capital can unlock broader transformation. This slide links the physical loop to the financial value loop. Avoided virgin material cost measures how much procurement spend is displaced by recovered inputs. Recovered asset value measures the value retained through reuse, repair, refurbishment, or remanufacturing. Secondary market revenue captures income from products or materials after their first use. These indicators matter because they translate circular activity into language that finance teams can track. Without such indicators, circularity may appear as a qualitative environmental program. With them, it becomes possible to compare investments, monitor performance, and report progress against financial objectives. The discipline is to make every physical loop visible as either avoided cost, retained value, or new revenue. These metrics help move circularity from narrative to financial governance. Financial barriers are often the reason circular projects fail to scale, but each barrier can be paired with a lever. Limited access to funding can be addressed through public subsidies and tax incentives. High upfront capital expenditure can be supported through green bonds or sustainability-linked loans. Unclear return on investment can be reduced by risk-sharing arrangements with supply chain partners. Transaction complexity and operational risk can be managed through servitized models that create recurring revenue and better lifecycle control. This diagnostic view is useful for executives because it turns barriers into design problems. Instead of asking whether circularity is too expensive, leaders can ask which financing, partnership, or business model mechanism makes the opportunity investable. Show that barriers can become financing questions. The financial case has three connected pillars: growth, lower cost of goods sold, and stronger customer value. Together they explain why circularity can improve competitiveness, not just compliance. Each pillar links operational redesign to a specific financial benefit. Decoupling means economic growth with falling aggregate resource use. At the macro level, the circular economy seeks to generate value from materials already in the system, rather than relying on continuous extraction. High-value loops such as reuse, remanufacturing, chemical recycling, and sharing can support growth while reducing total material requirements. This does not happen automatically. It requires deliberate design of products, infrastructure, and markets so materials remain useful at high value. The business relevance is clear. If firms can grow by extending the value of existing resources, they become less vulnerable to scarcity, price spikes, and environmental regulation. Decoupling therefore becomes both a sustainability objective and a financial resilience strategy. Connect decoupling directly to long-term competitiveness and resource security goals. At the firm level, circular configurations reduce the resource used per unit of value. Product service systems can raise utilization and generate recurring revenue. Life extension strategies delay replacement and keep assets productive for longer. Managed reuse returns recovered products to productive use. Closed-loop recycling substitutes recovered inputs for virgin materials. Sharing platforms increase the intensity of use for existing assets. Each configuration contributes to decoupling in a different way. The managerial challenge is to choose the configuration that fits the product, the customer relationship, and the operational capability of the firm. A circular strategy is strongest when it reduces resource intensity while also improving revenue quality, cost structure, or customer retention. Ask which configuration best fits each firm's assets and customers. Cost of goods sold is one of the most direct financial entry points for circularity. Virgin input spend can fall when recovered materials substitute for new raw materials. Waste and landfill costs can fall when firms avoid disposal, incineration, remediation, and penalty exposure. Life cycle operating costs can improve when reverse supply chains recover components, extend product life, or support second life use. The strongest cost story is not a one-time saving. It is a structural change in how the firm sources value. When materials circulate at high quality, waste becomes a recoverable input rather than a disposal problem. That changes procurement, operations, and risk management at the same time. Use COGS to make the financial impact concrete for operational leaders today. Circular initiatives also influence customer value and brand equity. Research on consumer behavior suggests that awareness of social and environmental sustainability can increase altruism, purchase intention, loyalty, and even brand evangelism. However, these benefits depend on trust. Customers need clear information, credible labeling, and evidence that the circular claim is real. If communication is vague or appears like greenwashing, the value can disappear quickly. This is especially relevant in categories such as circular packaging, second-hand fashion, leasing, and repair-based services, where customers must understand why the offer is better. For firms, circularity can therefore become a marketing asset only when it is backed by transparent operations and authentic value. Emphasize that trust converts circular claims into durable customer value creation. ROI, risk mitigation, and green capital access. This section focuses on the finance required to scale circularity. We look at ROI modeling, risk mitigation, and access to green capital. The key point is that circular investments must be evaluated across long horizons, uncertain demand, and resilience benefits. ROI modeling for circular infrastructure must account for complexity and uncertainty. Large circular systems involve facility locations, transport fleets, processing equipment, energy use, forward logistics, and reverse logistics. Hybrid robust stochastic optimization models help finance teams compare expected system costs with tail risk exposure across different demand scenarios. Entropic value at risk, or EVA, is one example of a method used to include extreme risk in the evaluation. The point is not that every manager must become a mathematical modeler. The point is that circular infrastructure should be evaluated over its full system life. When avoided waste, recovered value, lower volatility, and scenario performance are included, the investment case becomes more complete. Make clear that full system modeling reveals benefits missed by linear accounting methods. Supply risk mitigation is part of the financial return. Circular practices can act as hedges because they reduce dependence on single sources of virgin materials. Multi-source secondary inputs can limit exposure to commodity price spikes. Flexible remanufacturing capacity can soften disruption when demand or supply conditions change. Waste reprocessing can reduce environmental liability and future fee exposure. These benefits may not appear as a simple revenue line, but they support cash flow stability and reduce downside risk. Scenario models make these effects visible by comparing expected cost with tail risk exposure. For executives, the message is that circular investments should be assessed not only by average returns, but also by the resilience they create. Treat resilience as an economic benefit, not a slogan. Circularity can also improve access to capital when it is transparent and verifiable. Investors and lenders increasingly look for evidence that companies can manage environmental risk and build sustainable growth. Clear circular disclosure can strengthen ESG and growth signals. Green bonds, sustainability-linked loans, subsidies, and tax incentives can then help finance projects with high upfront cost and long payback periods. Green innovation may also improve investment efficiency and relationships with public institutions. The important condition is credibility. Capital markets need proof that circular initiatives are real, measurable, and connected to financial performance. When that proof exists, circularity can lower financing barriers and shift capital allocation away from purely linear models. Underline that credible evidence is essential for preferred financing terms. Second life value and secondary material markets. We now examine second life value and secondary material markets. These opportunities can create new revenue and reduce input costs, but they require major operational redesign. Firms must manage ownership, reverse logistics, material quality, and market uncertainty. Product as a service changes both operations and finance. Instead of selling a product once, the firm retains ownership and earns revenue over time. That means assets remain on the balance sheet and must be tracked across their life cycle. Reverse logistics, take-back, repair, and field maintenance become core processes rather than afterthoughts. Product design must also change, because durability, modularity, and refurbishability protect recurring revenue. The financial effect is mixed. Immediate sales are diluted into slower recurring cash flows, but lifetime margin can increase if utilization, uptime, and recovery are controlled. For a CFO, the critical issue is whether the company can manage the longer cash conversion cycle and operational intensity. This is why ownership models must be matched with strong lifecycle systems capabilities. Second life markets create both upside and tension. On the upside, remanufacturing, refurbishment, and reuse can lower production cost per service delivered and create additional revenue from multiple product life cycles. They can also support brand-controlled certified pre-owned positioning. At the same time, customers may be willing to pay less for remanufactured products, and second life offers can cannibalize traditional new product sales. Third-party recovery networks may also compete for residual value. This creates a strategic question for the CFO. Does the second life offer increase total lifetime profit, or does it simply move customers away from the new product business? The answer depends on pricing, quality assurance, channel control, and market structure. Use the question to challenge simplistic assumptions about second life profitability in practice today. Secondary raw material markets are essential, but difficult to operate profitably. Feedstock quality and volume can fluctuate across fragmented recovery networks. Information about material composition and disassembly may be missing. Sorting and chemical reprocessing infrastructure can be capital intensive. Complex B2B coordination can limit stable secondary flows. The enablers are equally clear. Companies need return and recover objectives embedded into supply chain performance. Regulation, environmental standards, and tax levies can help marketize waste by making recovery economically attractive. Cross-industry collaboration is also important because secondary materials must match precise manufacturing specifications. In short, secondary markets require both operational capability and supportive market architecture before they can reliably replace virgin inputs. Stress that infrastructure and information quality determine whether waste becomes input at scale profitably. Financial frameworks in practice. The next slides ground the frameworks in real cases. Genes, Banyan Nation, and Indorama Ventures show how different regions solve different circular finance challenges. Leasing and brand value, feedstock reliability, and large-scale recycling infrastructure. Genes demonstrates the operating intensity of product as a service. Its Lease-a-Genes model shifts the company away from immediate one-time sales toward recurring payments. That strengthens the customer relationship, but it also ties up capital and makes cash conversion slower. The garments must be designed for durability, repair, and recycling, because premature failure would damage the economics of the model. The reverse supply chain also becomes central. Returned garments must be triaged for resale, repair, or fiber recovery. The case shows that circularity in apparel is not just a marketing idea. It requires product design, reverse logistics, and brand meaning to work together so circularity becomes loyalty and long-term value. Connect the brand story to working capital and product durability. Banyan Nation shows how digital coordination can solve feedstock uncertainty in an informal waste economy. The company used data intelligence and mobile IoT tools to connect fragmented waste pickers into a more structured reverse logistics network. This helps stabilize collection volumes and improves visibility over material flows. The company also invested in chemical washing and thermal processing so recovered plastic could approach near virgin quality. That technical capability is crucial because manufacturers need reliable inputs, not unpredictable waste. For OEMs, the value is financial as well as environmental. Stable, higher quality secondary plastic can reduce exposure to virgin petrochemical volatility and make circular sourcing more credible at industrial scale. Highlight the link between data visibility, material quality, and lower sourcing risk for OEMs. Indorama Ventures illustrates circular ROI at infrastructure scale. The company dedicated more than $1.5 billion to international plastic recycling infrastructure, showing that large circular transitions require very large capital commitments. By acquiring and retrofitting facilities, Indorama expanded advanced PET recycling and chemical depolymerization capabilities. Chemical recycling can break degraded plastic back into purified resin suitable for high-value reuse, including demanding packaging applications. The financing lesson is equally important. Green bonds, sustainability-linked loans, and policy incentives can lower the cost of capital for long payback investments. This case shows that scale requires financing instruments that match the time horizon and risk profile of circular infrastructure. Point out that financial instruments make industrial-scale circularity possible, not automatic for firms. This comparison brings the cases together. Genes faces cash conversion and reverse logistics challenges, and responds with leasing, design for recovery, and brand equity. Banyan Nation faces unreliable secondary feedstock, and responds with digital waste networks plus processing technology that improves material quality. Indorama faces massive infrastructure capital expenditure, and responds with chemical recycling capabilities supported by green finance. The common lesson is that circular strategy begins with a specific constraint. Once the constraint is clear, the firm can choose the circular capability and financial logic that fit. Circularity is therefore not one universal formula. It is a disciplined alignment between operational redesign, capital structure, and value capture. Use the table to compare constraints before comparing success stories directly. The conclusion is that upstream redesign makes circularity investable. Growth can be decoupled from finite virgin resources when high-value loops are deliberately built. Structural costs can fall when recovery, reuse, and waste minimization are designed into operations rather than added at the end. Financial resilience improves when CapEx decisions include risk mitigation and access to green capital. Most importantly, circular success requires redesigning products, operations, and global supply chains around reverse flows. The business case is strongest when finance teams can see how physical loops translate into avoided cost, retained asset value, new revenue, and reduced volatility. Circularity pays when it is managed as a system. Close by reminding listeners that profitable circularity starts before waste appears in operations upstream. Thank you for your attention. Next, we continue with Course 4, Module 2, Chapter 4.